Right, so first rates, and let's see where markets open. Are we likely to see all of buying there? Well, let's see. You want to start with banks, big banks, PSUs and private banks combined, because that FI number just screams of that large cap buyers are back now. So HDFC Bank up another 15 rupees, ICICI Bank up another 11 rupees, and Axis Bank and IndusInd Bank are also giving it company. Now the PSU space, REC, PFC, the real poster boys of this year's real epic bull run. And REC flat, PFC not going anywhere. And let's look at OMCs now, oil marketing companies. What do we have there in terms of a mood point? Yesterday it was like a rising tide phenomenon, just about everything went higher. They're still very cheap even though rally has been very strong. So let's see what happens there. HPCL, BPCL and IOC off to a good start. So there is no rara rally in any of the large cap stocks. Power looking slightly weak, FMCG looking okay, IT not contributing, and with the exception of Kotak Mahindra Bank, I think there is a lot of follow buying in at least large cap banks.
Okay, that's the take coming in right now on which way the tide is headed on the large caps at least. Taking a look at some of the other names which are going to be in focus this morning, and just take stock of what the OMCs have been up to, because that was where all the firepower was in trade yesterday as well, and seems like they're good to go in trade today too. So look at BPCL still holding up 1.5% as we speak right now. There's IOC as well, about 1.5% move. Look at IEX. The November volumes have seen an uptick of about 17.5%. Electricity volume as well is higher by 13%. That stock jumps up 1.5%. Bharat Forge, wherein the North America Class 8 truck orders have been the highest in 13 months, up 31% on a month-on-month basis, 0.7% higher for this stock. Bank of India, they're looking at a very sizable QIP this week as well. A range of 34,500 to 4,000 is being talked about, 1.6% higher for Bank of India as we speak right now. There is JSW Infrastructure as well, wherein JSW Dharampur Port is looking to acquire stake in the PNP Maritime for about 270 odd crore rupees. So look out for that. CAMS, Great Terrain, remember yesterday sold 19% at a price value of 2766 in that sizable block deal that happened on CAMS yesterday. Today the stock is holding up by about 3%. But I think more than these stock specific movers, it's really about what the overall market is doing, and Kunal, not bad if we choose to consolidate today.
Well, absolutely. Consolidation at higher levels is always considered to be healthy for the markets. And I think with the kind of premium the indices are showing, both the Nifty and the Bank Nifty, as well as the higher support for these stocks, indicates that the markets are moving on to a higher level. So I think it's a good time where the index goes into a mild bit of an upward trend. But money or in the stock specific, there is money flowing into the larger cap names. HDFC Bank is something which I would be bullish on from current levels. So it was a trade which I initiated yesterday. I would look to carry forward the trade even at current levels.
All right, clearly sticking with the large cap banks. Meantime, let's find out what Naresh's strategy is. And Naresh, are you also tilting toward financials as your first trade?
Yeah, so continued like financials, the Federal Bank is the pick. The stock has hit a new all-time high, clearly an outperformer in the sector. So that is a stock which could go towards the 170, 180 mark.
Tahir Basha joins us now. Tahir, good morning. Thank you for joining us. Tahir, for a market which was bereft of any triggers a couple of months ago, everything is going just in the right way. Looks like bulls cannot put a foot wrong. Election worries are over. I lost him there. Never mind. ICICI Prudential on your screen. There is a block deal, I think, in Shriram Properties. It's not a market where you are seeing a lot of buying which is happening after yesterday's comeback. But in general, I guess the market breadth, which is the talking point, where are Adani group of stocks yesterday?
Record levels for most of the sectoral indices as well, the likes of banks, etc., all holding out quite well. But yeah, check in maybe on what the Adani names are up to.
Yeah, I mean, there is no follow-up buying. I mean, yesterday I think it was like a deep swell there. But, now you got to say yourself that what is the worry in the market? If there is no worry in the market, then obviously prices will also build up to some kind of a consensus. All right, Tahir, for a market which was bereft of trigger, let's say 3 months ago, looks like bulls cannot put a foot wrong. There is just too much of cherry consensus why one should buy equities. Do you think markets are now priced to perfection?
I would like to think that basically, I think we are still in a mode where valuations can be a little deceptive. And because we're probably likely to see earnings upgrades. Even the last result season, I think we saw a lot of earnings upgrades come through in several parts of the market. So I think if that were to probably continue going forward, then what probably appears as a little expensive market may not necessarily be so. So I think that is, as of now, what will keep the market momentum up. The expectation of earnings revisions as we go along. There are some parts of the market which are clearly in momentum. Valuations are somewhat ahead of what the fundamentals probably dictate. But I think there are a good section of the market which is reasonably realistic. I think there are businesses which have shown a significant deviation from the trend of the general market and probably their competitive peers. And therefore, market to that extent has probably been right in pricing them a little more expensive compared to the rest. So I think that's what probably I think will continue to be the feature of the market for some more time. When we look at it from the perspective of the Nifty, we all know that we are trading at a reasonably decent valuation. We're at about 19 odd times, 1 year forward earnings, and we've seen higher levels in the past. There could be different reasons attributable in the past, but we don't really think that this is a number which will really create a lot of flutter in the market in terms of having reached overvaluation zones. And besides, we are still sitting at the peak of the interest rate cycle, so that will have its own relevance and bearing on the overall valuations of the market.
All right, that's the picture when it comes to the overall valuations. Tahir, morning. Let's understand then what the outlook is when it comes to the overall liquidity situation, given that we have seen the re-emergence of FIIs as buyers into the market, and given the last pattern that we've seen over the last year and a half or so. Do you think that with the current move in the market, it will compel them to come right back and stay invested in India?
I would like to think so. I mean, we hear a lot of chatter about the fact that, foreign investors have been on the sidelines in the recent past, more because of the expectations around the elections and so on, and the political scenario. And therefore, I think with some clarity around that, I think they should be a little more confident about, the near-term approach to the market. But I think on a more longer-term rationale, I think two things will stand out. One is obviously our growth prospects, which are definitely better than most of the rest of the world. And alongside which, what we are also witnessing slowly and steadily is the stability of the currency. The rupee has behaved a lot better and has been, depreciating a lot lesser than what it used to in the past. We have seen about a 4% depreciation in somewhere between 2005 and 2013. And in the last 10 years, it's been more like 3%. And probably with the initiatives that we are currently on with, if we see a relatively better stability in the rupee compared to versus the dollar, then I think that will probably add to the, more positive sentiments as far as foreign investors are concerned, whether it is FDR or FII, or whether it is equity or debt markets.
Right. Tahir, for those sitting out with a FOMO feeling or wondering whether they should have participated more, should have been fully invested, what's the message to those investors? Where is it that they should be looking at adding positions or buying afresh, if at all you recommend that in this market?
So, Asha, what we've been telling our investors is basically that, as far as the broader market is concerned, which is essentially the mid caps and small caps, you're better off probably, now that we've seen a reasonably strong rally in the last 9 to 10 months, it is probably better to, and you want to probably be a little more disciplined in your investing, then I think an STP, SIP kind of an approach is better out there. And as far as newer investors are concerned, or probably those who want to actually allocate fresh money or in lump sum, I think we are recommending them to take the flexi cap route or the multi cap route. That's a relatively more balanced approach. We think we'll probably get a overall better value entry valuation as well. So I think from a more product choice perspective, this is how we are basically messaging investors. But by and large, we've all known this, and we are in a good cycle. We are likely to be in this positive economic momentum for the next few years, and beyond a particular point, there's no right time. I think we just need to kind of get into the bus and probably, have that patience to wait it out. If you get corrections along the way, you use them to your advantage. That's essentially the approach. There's no other way out of this, and it's as simple as it has always been in the past.
Okay. Tahir, in the run-up to the election, normally markets, they rally. Do you think history will repeat itself?
So as I heard you say a few minutes ago that the markets don't have really much to worry about at this stage, and that typically is a time when you can get those kind of surges in the market, and I would like to think that those the next 3 or 6 months probably will be more of that. So I think much of the returns which can probably come in 2024 might now get front-ended, and you probably then might see the markets pause or trend downwards a little bit the subsequent part of 2024. So I think you're right, it's quite possible. I would attach a higher probability to the fact that you might see euphoria, you might see a blowout rally in the next 6 months.
What would be the top sectoral bet then or theme that you believe investors can really bank on to ride it out for the next year, Tahir?
I'm sorry, can you just come again? I lost you along the way.
Your top sectoral theme for the next year.
Look, I think good part of it is actually continuation of what we've seen in 2023. So I don't know whether I'm going to say something very absolutely new, but I think from a growth standpoint, we're basically looking at essentially themes which are things like premiumization, luxury and lifestyle, spending, healthcare. These are the things which probably will dominate as we go along into 2024. From a more value standpoint, we think there is value in financials, and more importantly, the financial canvas is actually becoming wider and larger. Maybe 5 years ago, 10 years ago, it was largely about lenders, and whether it was banks or the non-banking lenders. Today, the entire ecosystem is a lot more wider, comprising of several other components. So it is a combination of lenders and non-lenders. It's a combination of offense and defense. It is a combination of platforms and balance sheet oriented companies. So I think that's something which is a place where we find reasonable value, and overall valuations are comfortable. I think you will probably see somewhere value emerge. Excitement or growth emerge back in technology towards the second half of 2024. So that's an I would like to think it's a more cyclical opportunity at this stage. So I think these are the places where we are hunting. We are trying to see whether we can probably find opportunities and ride them.
Sure. Great to have you on the show then, Tahir. Thanks so much as always for taking the time out. Let's just revisit what the rates are settling in at. And it's a day of consolidation. We're not complaining. The Nifty, though, is inching up a little bit higher than that, 20,747, clearly 21K inside. It's once again the Adani names which are actually, holding out very smartly. Adani Enterprise is up 4.5%, Ports up 3%. There's, of course, BHEL as well looking very solid, 2.6% of a move. And OMCs continue to chug along very, very nicely. HP, BP both holding up 2.25% as we speak right now. Safir Anand joins in on the show as well to join in into the celebration. Safir, hi, morning. Great to have you on the show. How does it feel? What a resounding victory, and clearly hinting of a continuation perhaps in 2024 as well. Markets clearly liking that.
Good morning and thank you for having me over. As you can see from the color of my shirt, it's in the pink of health, the market and the economy and the government. So everything looks quite cheerful as of now.
Yes, it sure does. Looking like a wow, as elegant. We couldn't have asked for anything better. But Safir, what's the strategy now? You have to be fully invested. Do you take some profits off the table, keep some powder dry? Because, fact of the matter is there is still a very big impending 2024 election.
See, first of all, at a personal level, I'm fully invested. Secondly, that does not mean that I don't take profits off the table, because in a portfolio, you could always be doing some level of shuffling, particularly if you sense there's some exuberance in the market that you would not like to participate in. And then you will look at value in other sectors where you think that there could be a catch-up. So there is a little bit of shuffle that always happens in a portfolio. and I would have done effectively the same. But from an investment perspective, I'm fully invested. I had actually made a 13 pointer for you on why I think the market should continue to be bullish for 2024. Those 13 points are as follows. First of all is the GDP data, which has now caused even the rating agencies to upgrade their estimates for India. It was far ahead of expectations. The second is the turnaround that is happening in many PSUs. I heard our petroleum minister speak about 50,000 crores profit in BPCL. And there has been so much of skepticism around owning of these companies because they've not seen as profitable companies and more of dividend plays. But that's completely changing. The third is the GST collections that seem to be more robust and the more adaptability by the economy towards GST, which augurs very well for the listed sector. The fourth is reforms in sectors such as power and infra, because those are technically considered to be more laggards as compared to the consumer and the IT and the healthcare sectors. The fifth is the observations by the Honorable Supreme Court in the Adani case, although the matter is still awaiting judgment. But I just saw a tweet from ET Now just a few minutes back that even a US agency has, held that the report may not hold much substance, the report of accusations against the Adani group. The sixth is the reforms made by SEBI. For example, it is unprecedented that you apply for an IPO and you get a allotment within 1 day and you have a listing within 2 or 3 days. So the money unlocking the money is never locked, and therefore the money unlocking process and the level of transparency is very high. There are also very good amendments that have happened on the bond side, and that is causing an interest on that sector as well. The next is the general fact that the retailers are making money across all segments. They're not limited only to equity. Gold is doing exceptionally well. Bitcoins are doing fine. Irrespective, housing is doing very well. So generally, there is wealth creation across sectors, which will generally cause greater interest in asset classes, of which equity will also be a part because you could have a diversified portfolio. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are because they will now, there's likely to be participation, particularly in the large cap names, which is what the market is seeing in the last week or. The next is that, there are certain pockets of valuation. For example, PSU banks still trade at 1 times book value, and yet they're reporting very robust numbers. Even the private sector banks are now quoting at less than the historical valuation price to book. So there are pockets of market that seem to be of interest. The next is the role of RBI, which has been way ahead of banks all over the world. The entire world banking sector seems to be in a crisis, and RBI seems to be in complete control. And the kind of worries they have on the inflation front means that they will look at problems. I personally also feel that the interest rate hikes will not happen, and that could be a big positive. The next is the upgrades by the rating agencies, which typically do not like to upgrade India, irrespective of the fact that Indian economy does so well, but they have increased at least the estimates for India. The inclusion of Indian bonds, which generally means that the feel-good factor for India has improved at a macro level. India's contribution vis-a-vis MSCI also has significantly improved. It used to be some 8%, and it has now moved up to, I think, something close to almost double or more than that. And generally, the fact that there is so much of liquidity in the market, which is extremely comforting for an investor, because liquidity in the market is the main criteria for investing. If I need the money, I should be able to sell a stock and get the money. And today, that money comes to me in a matter of seconds. And you can see so many block deals are happening, and those block deals are getting absorbed in a matter of hardly a few minutes. So these, according to me, are factors that should sustain the bull market, at least for 2024. And the last factor, the stability of the government, which is a very, very critical thing. I've kept it for the last because it is one of the critical factors. I personally feel that the stability of the government will cause them to be able to pass more bills in the parliament and therefore concentrate on long-term benefits for the economy rather than be fixated by a worry on what is going to happen in the general elections.
Okay. How did you manage to remember 13 points?
He jotted them down.
I have to remember what I'm doing.
No, by 13 points, man. I mean, I'm been doing television anchoring for years now. I'll not even remember.
It's also the passion of remembering what you like.
Okay.
And the
Yeah.
passion for markets.
Yes.
I mean, you're comparing FI to HNI.
Yeah, true,
कुछ
true.
तो difference
डिफरेंस
ना.
है. अच्छा, आप 13 पॉइंट की जल्दी जल्दी स्टॉक लिस्ट बना दो, चलो वो फटाफट.
See, the thing is that
नहीं वो तो लिस्ट तो पता भैया, वो तो याद होगी. जब पॉइंट्स याद है, स्टॉक लिस्ट तो 26 27 जो भी हो तो पक्का याद होगी. चलो, आई गॉट अ पेन एंड अ पेपर. लिखना है, चलो 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 फटाफट. टिकर गेट रेडी, विल फ्लैश.
I will tell you that, but my point is, whenever you have been kind enough to invite me on your show and whatever stocks we are speaking, they end up doing well. So the question is that do you penalize something that is doing well? And I don't mean well in terms of stock performance, I also mean well in terms of earnings. I think many of the stocks have been re-rated 4 to 5 times, and therefore there is technically no reason for you to sort of get out, because still after getting re-rated, they are within the realm of reasonable valuation commensurate to their growth. But you know, the sector that appears to be very well positioned continues to be banks, and the PSU sector. I think that positions in the banking sector and the PSU sector seem to be rewarding very well. I just gave you an example of the kind of profits that are expected out of BPCL as an example. The spending on infrastructure is so large, and you're not hearing the stories of problems in terms of payment or defaults. In fact, more work is moving towards the organized sector because the scalability of the projects is going up and they are able to execute in a much better way. So, within the same pockets, whatever you want to own or whatever basket you want to own is working the best for you.
Okay. So let's make a list of 2 or 3 buckets. Stocks which you think can be classic compounders from here. It's like that old Hero Honda ad: fill it, shut it, forget it. So buy it, keep it, and forget about it. Classic compounders. Doesn't matter what happens in May 2024, does not matter what happens to Fed. You're happy to own them for 5, 6, 7 years. Second, stocks where you think it's time now to perhaps have a tactical trade, which is that either they're on the cusp of a market share gain or perhaps the sector could do well, like OMC. They're the cusp of a profit curve now. And third, stocks which you think that they are pure concept stocks. I mean, they could do well, they may not do well, but if that theme becomes big, for example, food delivery was a concept few years ago, it has translated into reality. Defense was a concept post-COVID, but it has translated into reality. So 3 buckets.
So banking would, for example, be in bucket 1, and in banking, I would now, historically, I've been for the last few years in favor of PSU banks, but I now believe that it is also time to look at some of the private sector banks. In the private sector banks, I have owned and spoken about banks like ICICI, and many of these stocks have done exceptionally well. But now I also feel that some of the more obvious names, such as an HDFC bank, may have a greater traction from here, considering the impact of many of the 13 factors that I spoke about. I also believe defense is in a long-term play, and while defense may see corrections because somebody or the other may come and book profits, there will also be an equal number of buyers. And a lot of people talk about the price to earning ratio in defense companies as having run up too much. I actually believe that the sector is going from a complete substitution of import into a make in India sort of feeling. And the third would be pockets of manufacturing, because the capex cycle has just started. The private capex cycle has just started. So I feel that the cycle doesn't start and end in a matter of 6 months, and therefore there could be large ticket benefits there. Now, they could be in the second pocket that you're talking about, like you referred to OMCs. Right now, I'm buying selectively, or I have bought selectively PSU stocks and I'm not talking about banking, but non-banking PSU stocks, because I do believe that there's a sort of a good wind in place. They could be engineering companies, they could be infra companies, they could be pockets even like private sector infra companies, like a more mature name like Larsen and Toubro. There are pockets where the market, behaves very strangely. For example, last few days, iShares got dropped because of the fact that there was a Harley Davidson launch. But actually, I believe that Siddharth Lal is not a guy who sits quietly, and he will not, he avoided media during that time. But you obviously can anticipate that something must be in his mind. The market is now looking at Himalaya, but I'm also very interested in what he does on the Volvo side, which for now should be a business that should pick up, particularly with the kind of changes that have happened on the road front. There will similarly be problems, for example, even in a company like Hero MotoCorp, if you saw that there was an ED action and there was a huge reaction on the stock. but then you come back into basics of how many motorcycles are being sold and what is the business potential, and you look at those kind of stocks. Some of these stocks have moved up 20% odd for the month. So, you will get opportunities there. There are good companies going sometimes through bad cycles, and you can look at some of the opportunities. And the third pocket to me are right now this small caps, where there seems to be certain pockets of exuberance. There are, for example, small cap companies which people talk about on social media in terms of the kind of returns that they have given, ignoring the fact that nobody talks about their business. Nobody actually knows their business. It's just that you look at an EPS and multiply it by a certain factor and say that they are very good and they are in trend and they are going above DMAs and etc. But when you go to the real market, which is not the stock market, but in the real market, you really don't know anything about these companies. And many of them resort to QIPs and other fancy forms because that's the history of the market, that the promoter knows when to sell. So those are the pockets that I would typically avoid. I'm also generally avoiding the consumer sector right now until I find that the inflation in rural India is more under control, and also rural India shows greater traction towards growth, which is very evident in the housing and infra sectors, but not so evident on the consumer side. So those are the pockets where particularly you asked me 3, I've given 4. So I've tried to justify one more for you.
Okay, what about power? There is enough, and I mean, this was a sector which was considered to be ugly duckling. Low return on equity, always dependent on government policies. There was no clear, coherent arrangement for most of the private sector companies. But today, power stocks are going higher as if there is no tomorrow. Do you think there is a froth in power as a theme, as a category?
No, so Nikunj bhai, you have been in the market and you've been a veteran for so many years and you analyze the market in so many ways. If I believe the fact that there could be exuberance, first of all, I have participated in it, so there are profits. But if I believe that there's exuberance, it's like the mining story that happened in California. So you don't own the mines, but you own the companies that enable the extraction. So technically, if you look at the power sector, it causes an indirect benefit on cables and wires and segments of that sort. Even the pump sector, because the pumps are also required, if power, the ability to extract goes up. Pumps are used in mining, they're used in construction, they're used at housing level, etc. So you can look at some of the indirect beneficiaries of that. And then there could be pockets, for example, some of the public sector companies, anyway, they come in my PSU bracket, have done exceptionally well. But there have also been pockets such as Adani Power, which is one of my top holdings. And I think Adani Power had come down to maybe about 175 odd rupees. And then I was hearing all the good statements coming from one of its largest investors, which is the GQC group. And, you could basically look at that and you come and say that if the reforms happen, and you're also trying to see what is the diversity in the power company. For example, are they only dependent upon power, or they do solar and they do wind and they do other things? The last time when I came on your show, I spoke about Suzlon. Now, many people drub it as a bad company for historic reasons, but they do not see the management change, the change in government policy, and the valuations then become attractive and the QIP gets mopped up immediately. I participated at the same time. Now, those are the kind of reforms, but they would probably go in bracket 3, which is that you're playing the trend for now. And if the trend continues, the bracket 3 could move into bracket 2. But if the trend does not continue, or for example, the valuation goes way above your head, then you will sort of say that I don't mind taking profits because historically they've not been wealth creators. But I'm also not as rigid as I used to be. For example, I may dislike the company, then there may be changes in the company, and I may like the company, and I keep telling myself that that's how you evolve as a thinker.
So, Safir, are you going to repeat after me, or will it be a solo? So beautiful, so elegant. Come on. I'm sure you've said that many a times off cam.
Well, we all as a country are so beautiful, so elegant, and just like a wow right now. So I'll toast to each one of us.
Great. And that note, Safir, stay elegant and stay like a wow forever. We'll take a very quick break and we'll, of course, let you go on that note. Okay, take a break, like I said, and we're holding up in the green about 0.5% or so. When we come back, we'll have Hiren from Alchemy Capital join in.
Joins us now. Our viewers been always look forward to hear his views, and this time around we've literally managed to juggle him and we've wrestled him out of his meeting with a late-minute interview request. So, Hiren, thank you very much. I know it's been helter-skelter for you, yet you've accommodated this interview request. So, thank you very much.
No, always a pleasure, Nikunj.
Hiren, while we managed to wrestle you out of a meeting to join us on ET now, the feeling for a lot of investors now is that of FOMO, where they just want to now come and they want to jump on the bandwagon desperately. So how would you map the risk reward ratio for the markets now for next couple of months in the run up to the election and post that?
So I think, Nikunj, the thing is that we can see the FOMO effect in the IPOs, right? Because the kind of liquidity that is going into the IPOs tells you that there is so much of cash lying on the sidelines. And on the other hand, people who are quite apprehensive going into an event like the state elections. But I think, it's still not late to be part of what we all believe is a long-term structural bull market. As you remember, Modi ji said that this is not an era of war. Just like that, this is not an era to be bearish on the Indian markets, right? This is an era to be bullish on India. So my sense is that there is still an opportunity. While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. It's time, in my view, that elephants will dance. So I think there is still an opportunity in the large caps. Not to say that there is no opportunity in the small to mid caps, but I think in a bull market, there's always sector and market cap rotation. So my sense is that, at least in the run up to the elections, you may now see some of the larger cap stocks which have moved sideways should also start to participate in this bull run.
Rarely do we see that the discount between large cap and small cap is so stark. It's always the other way around. Large cap, they move up, and then small cap stocks, they catch up. Right now, the tail is wagging the dog. Now, India's market cap to GDP is already 4 trillion. And historically, when the market cap to GDP has gone above 1, that's always a red sign according to Warren Buffett market cap to GDP indicator. So my question is that market have already run up. And if large cap stocks now participated, won't we reach then what could be called as froth or a bubble level?
So Nikunj, this is obviously a broad indicator. But if you look at the US market, right, it has stayed above, the market cap to GDP has stayed above 100. In fact, it is closer to more like 130, 140% for a long period of time. Right. So there is nothing to say that market should always be below, market cap to GDP should always be below 100. I think there will be times when the opportunity and the visibility of growth in India relative to other markets is significantly better. So I don't see a reason why our market cap to GDP cannot consistently remain above 100%. I don't think we've reached those absolute bubble valuations. How can we talk about bubble valuations when until recently your Nifty was for a 2.5 years was largely in a consolidation phase. We had similar Nifty levels in September, October 21. And up until the last few days of this year, the Nifty was hovering around 18,500, 18,600. It's only now that we've broken out into new highs, right? And at 18 times, 17.5, 18 times 1 year forward, I don't think we are excessively valued as a market. There can always be pockets of overvaluation, But I think overall as a market, I don't think we are overvalued.
So let's pick up some themes where there could be a combination of value as well as growth. When we spoke to you about a year ago, you had identified EVs, you had identified manufacturing, you had identified to some large extent luxury consumption. Are those themes still intact?
So, Kunj, I think long-term leadership in a bull market doesn't change, but it is quite possible that some of these sectors which have done so well may go sideways, or there might be a time correction. And maybe some of the sectors like financials which have lagged may now do well in the near term, right? So a definition of a bull market is that everybody participates. Somebody participates early and somebody participates late. So my sense is that while the leadership in this market will continue to remain in capital goods, in manufacturing, in PSUs, but I think it is quite possible that large banks and FMCG might also join the party for a while, because in a bull market, everybody performs, some higher, some relatively lower. So I think it's time, as I said, for the elephants to dance, and some of the sectors which haven't done well might continue to party, but that doesn't mean that the leadership changes. I think the leadership that has been there with manufacturing, with cap goods, with autos, with defense, with PSUs will continue to remain. I don't see that changing.
Where are you debating internally and also with your team that should we stay invested or should we book profits? I mean, it's a difficult choice because stocks have run up and valuations are not very cheap in the stocks which you own. So where are you debating this internally?
Nikunj, there is no debate. I think we are very clear. We have to ride this bull market. Obviously, unless we believe that there are some stocks where the valuation is completely out of whack, or maybe because of risk management, if certain stocks have become a very large part of our portfolio, we may trim it. But I think the idea is not to sit on cash or to book profits. I don't think that's how you play. That's how you play a bull market, right? I mean, between 2002-3 to 2007-8, one of the defining moments was that if you never got off the horse, right? If you didn't try to be too smart, trying to catch the tops and bottoms, but if you just stayed invested, then you made the best optimum utilization of the bull market. Look, I mean, these kind of secular bull markets are not going to happen every time in a country's life history. So when it comes, you got to clutch it with both hands with a lot of conviction. And I think we and within our team, we have sufficient conviction to stay invested and not sway by, short-term volatility, or, we may take advantage of some overvaluation by trimming a couple of positions here or there. But I think we are very clear. We are remaining fully invested and committed to this market.
And since we are playing a little bit of animal zoo game here, we're talking about elephants and we're talking about horses here. Let's talk about the cubs. Which are the cubs of the market where you want to catch them young and they could be the tigers of tomorrow?
So I think, Nikunj, they are across sectors, right? I mean, whether you want to catch a tiger cub or a lion cub or an elephant cub doesn't really matter. But as I said, there are opportunities in manufacturing. There are opportunities even in higher end consumption, premium consumption. There is opportunity in all the sectors, right? So I think we are agnostic to where we see opportunities, but we have looked at opportunities in very specialized areas like tech, infrastructure, consumption, where these companies are still sub 10,000 crore market cap, and where we believe that many of them could be 4x, 5x over the next couple of years, right? So I don't have a specific sector bias, but I think the opportunity is large and wide. And we believe that, we have to pick and choose. So it's more bottoms up than top down.
So, Hiren, let's look at themes where markets have been disproportionately excited. Defense, power, railways. Are these businesses, these are great businesses, year from now, 2 years from now, 3 years from now, the businesses will be bigger. The companies will be bigger, profits would be stronger. But are markets pricing in FY27 and FY28 kind of earnings setup already?
You're right, Nikunj. I think in many of these sectors that you mentioned, the markets are pricing in, better growth, higher for longer, right? On the other hand, when you look at areas like rural consumption or agrochemicals or even specialty chemicals, I think those are areas where stocks have corrected and the near to medium term weakness is being seen. So it's about portfolio construction, right? I mean, you have to stay with the leaders, but you also have to be mindful of the fact that a lot of the future may be in the price. So that means that your time frame is elongated for you to really make money. And look, I mean, even in these sectors, who knows, right? I mean, they may continue to surprise even on elevated valuation. So we don't know. But I think that, as I mentioned early on, that from a risk reward perspective, it is quite possible that sectors that haven't participated or haven't done well may incrementally now participate. So there are opportunities there from a risk reward perspective, and some of the darling sectors might go sideways and time correct for some time. But again, you can't time all of these things. You have to stay invested if you really believe in the structural story, which we do.
Exactly a year ago for the December year-end special, the names you mentioned were largely the smashed out names, out of fashion names, Paytm, Zomato, and that call has rather worked well for you. Where are you picking your spots right now? I mean, what could be, if comeback in consumer tech and fintech was the trade you identified in December 2022, what would you like to identify for our viewers in December 2023?
Nikunj, I'll come back closer to the end of the year. But, you mentioned about the internet names. I think last year was a great time to buy them. My sense is that if in 2024 we do have interest rates correcting and the US Fed cutting rates and then, followed by a rate cutting cycle in India, I think there is a long runway of growth for companies like Zomato and Paytm. So I think we still like them. I think there is still an opportunity to make money there. But, difficult to see. I would think that if you're a long-term investor right now, we are looking at, areas like, specific opportunities in agrochemicals, chemicals, pharma, and even a few select manufacturing companies that have still not run up that dramatically.
Where would you be tempted to block or lock profits, whether it is risk management or a pure call on perhaps valuations? Because ultimately, when you're buying something, you'll have to sell something because you're fully invested. That's how you'll have to change orientation.
So as I said, right, I mean, we would trim in some of our, early bets that we've taken in manufacturing, or for that matter, any company which has become an outsized part of our portfolio, right? I mean, we've done very well on the ER&D side. in tech. Some of these companies have really done phenomenally well. And we could take some money off the table there and reinvest there in other areas that I mentioned, right? So, I mean, that's more a portfolio management decision than really trying to reflect our view in terms of where we are bullish in the market cycle. So I think we'll continue to remain invested in the leaders. We may trim it here or there, but I think that, as I said, there is opportunities in every sector, frankly. I don't want to single out. We will look at opportunities where we think, and as I said, that, at the margin, it looks like that many of the large caps might do well in the run up to the elections. And maybe the mid and small caps can join the party back a couple of months down the line, right? So that's quite possible.
Is the large cap, or which are the large cap stocks you're particularly excited about for next 12 to 18 months?
I would say cement, cap goods, banks. These would be the areas that I would look for in large caps.
Bank and cements, there are mid-cap cement stocks, there are large-cap cement stocks, there are mid-tier cement stocks, there are regional cement stocks. Within banks, there are private banks, PSU banks, regional banks, old PSU banks. Just narrow it down for us.
Well, I think right now, large private banks, large cap cement stocks, I think that's how we would look at it, right? And large cap auto as well.
With banks, don't you think it's a challenge of positioning? Because, I'm yet to find a bear on HDFC Bank. The only bear on HDFC Bank, I think, would be in Baikala Zoo. So the whole challenge with banks is that it's one of those spaces where everybody is fully invested, or perhaps is benchmark committed.
Yeah, I mean, they had a good run before that, right? In the recovery of COVID, you had a great run. Also, they had the best time in 22-23 when both, when all three, NIMs, credit costs, and credit growth were in their favor. And also the stocks were relatively over-owned. And since FIs were absent from our market and they were consistently selling, there was also a technical reason why the banks didn't do well, right? As I said, I don't see them as the leader of the next bull market for sure, but will they participate and will there be a mean reversion in their returns? I certainly think so. I think private financials, especially the lenders, were the leaders of the previous bull market. I think this time within financials, the non-lenders could be part of the leadership pack, right? So your exchanges, your online brokers, your what you call market infrastructure players, asset management companies. I think those have a better chance of being leaders of the bull market. But I just feel that given the underperformance of the large banks, you can't have a new bull market and Nifty hitting new highs and these guys not participating.
So, Hiren, you're on air and we got live queries saying that, okay, Hiren has already promised for a show for year end where he will be sharing ideas. Shall we block the date? It's 5th of December. When should we record that show?
To the extent that, compliance allows me. But yeah, I mean, happy to come on air again with you, Nikunj, closer to the end of the year.
Some ideas and themes for 2024. Really appreciate your time. So glad you could join us. And thank you once again for accommodating this last minute interview request.
Thanks, Nikunj. Thanks for having me. Bye-bye.
Okay, let's move on and let's stock of what's happening in the real economy right now and on ground, and what's the state of infra as we speak. Who better than Vinayak Chatterjee to highlight exactly that? And Vinayak, hi, good morning. Good to have you on the show. Since there are so many ancillaries of the larger infrastructure story that you track, let me start off with the power demand, because in the last 8 months have seen a very, very robust 8% kind of growth thereabouts. With the kind of GDP figures and PMI figures coming in, do you expect the fiscal year energy demand to show double-digit growth?
Look, high single digit or double digit growth is well spoken for. I think everybody who's tracking the power sector has figured out that some interesting dimensions are happening in the market. One, as you rightly said, the domestic consumption across all sectors is growing very, very favorably. Now, added to that is the fact that there has been a conscious slowdown in the addition of fresh thermal capacity in the last few years, with the expectation that renewables would kind of fill the space. Now, what has happened in renewables is that while the execution is, shall we say, energetic, the targets being achieved in commissioning new renewable plants are not in keeping with the targets envisaged a few years ago for various reasons. Land, transmission, the restriction of imports from China, the slower scale up of domestic capacity or domestic capacity selling at better prices to the US. So there's a variety of reasons. The net effect of this is that in the power sector, all these are combining to forecast a scenario where at least certainly in the next 5 to 6 years, power rates are going to go up. So most people are betting on a fairly attractive increase in merchant power rates. And therefore, there is an unwillingness to sign long-term PPAs at relatively lower prices. So I think the government has kind of figured this out and therefore has kind of partially reversed its let's not get excited about coal thermal stance to say that no, in the journey forward, medium to long term, we've got to keep a healthy balance between fresh capacities in coal thermal as well as stepping up capacities in renewables. So net, for private power companies, and since you are looking at stock markets and financials, the next 5 to 6 to even 8 years look very good in terms of the rates that you would get from the market, particularly merchant rates. But let me stop here.
Sure. You know, the government, Vinayak, given hints that one needs to look again at thermal as a source of power. Do you think they will have to go to nuclear as well, a hybrid model, fusion that is, given that peak demand would be very difficult to be met by purely renewables?
No, peak demand will never be, the demand will never be made by renewables. See, things like nuclear, there is, as you know, India and US have signed an understanding to promote this new technology called small reactors, small module reactors, SMRs. Now, by the time, and apparently they are going to be installed in PPP mode. Now, these things will take time to unravel. So these are all what I'd call peripheral attempts. But the big shall I say, striving in the market will be the nuanced setting up of more thermal than envisaged and removing bottlenecks in renewables. So it will be a coal thermal play once again. This year, I think we are going to be adding fresh capacity of about 10 to 12,000 megawatts in coal. And you're going to possibly see this trend again, where fresh new plants in coal thermal get encouraged by the government in parallel with renewable expansion. But everything else is kind of peripheral. And within things like hybrid and storage and all that are within the renewables game. So I'm treating renewables as one basket. And the real trick ahead is to actually reverse a rather hard stand earlier of no coal thermal, and which the government is doing and saying, no, we need coal thermal and we are going to go about in a more practical, nuanced way.
Vinayak, so if energy transition is the big theme both locally and globally, which end of the energy transition do you think would be a successful one? For example, wind has not been successful. Solar has that own issue of start and stop and start and stop. Green hydrogen still a concept on paper in terms of what it can potentially achieve. So if energy transition is the theme, who would be the biggest beneficiary?
Look, energy transition is certainly happening. And you would probably see a 3:1 ratio between new capacity in renewables versus new capacity in coal thermal or traditional sources. Now, coming to your question, it is obvious that in renewables, the real game is in solar. But earlier, the emphasis was on setting up solar generation capacity. Now, there is a lot of pipeline on that happening across the country. In Kutch in Gujarat, Khara, Rajasthan, Madhya Pradesh, across in the south, Tamil Nadu, there's a lot of fresh renewable capacity that's coming up. But the emphasis has now moved to storage because, as you rightly pointed out, this business that when the sun sets and I can't produce more energy is actually becoming dysfunctional for the market. So the real action now in renewables is actually moved to storage, and storage comes in three sizes. First is obviously battery storage. The second is pump hydro storage, where you use renewables during sunshine hours to pump up water, and at night time the water comes down, cascades down and runs turbines and generates power. So you're able to run renewable 24/7. And the third is, of course, hydrogen and green hydrogen, green ammonia, or hydrogen and ammonia. So today the market is very attuned to saying, let's now focus more and more on storage solutions, along with obviously setting up renewables capacity. That's the new game in town. Storage is the new game in town in renewables. Even bids are coming out asking for 24/7 power.
When I speak to some power producers and companies which in a sense are offering storage technology, their view is that there could be a dramatic cut or drop in cost of storage. It's like floppy disk. Every year the cost of memory storage keeps on coming down. Could that same happen to, let's say, storage and other modes of alternate energy? Because there was a time when solar power was 15 rupees a unit. Now it's down to about 3.5 rupees a unit.
Storage has its constraints. I don't think it's following the same trajectory as the rapid decline in solar module development, which has been largely a very fast and furious technical development in terms of giving more and more power to the panel to soak in more sunlight, to soak in the same sunlight and produce more power. In the case of storage, really, if you forget hydrogen and ammonia in the short to medium term, we are left with battery and pump storage. So far as battery is concerned, I think we have the issue of getting adequate supplies of lithium. While there are innovations in technology happening, the broad feeling is that it's not happening at the fast pace that you saw in computer chips or in solar modules. It's a far lower trajectory of reduction of cost. So far as pump storage is concerned, it's a pure civil engineering, civil construction play. That you've got a structure that lifts water up and then it falls down. So there is a limitation on how much you can do in pump storage. But these two are major factors that will change the renewables game in terms of producing a fresh new capacity for storage, which will take the renewables business to a 24/7 market as distinct from a sunshine-only market.
Every time we've interacted with you, you've always obliged our viewers with some ideas which would be actionable. You may have guessed my question by now, which is that if one is looking at investing, which end of the market, in your eye, is going to see earnings growth? I'm just going to bring this for our viewers. 4 years ago, Vinayak was of the view, invest in infra companies. They've done very well. Then he was of the view that you look at companies which would benefit because of water connectivity. They've done rather well. So what's the next big idea where our viewers can have some actionable, thing?
Look, in the construction-based infrastructure, I think you yourself would have tracked the very large increases in order book in companies like L&T and Megha and various other construction companies arising out of very rapid increase in public expenditure and infra. So construction companies are still attractive. The ones that are well run are still attractive. And as we just finished the discussion, and even distribution companies, discoms, are actually spending a fair amount of money on smart metering. So I think, and there is a lot of work happening in the revamp of distribution circles. So people in the cables, insulators, smart meter businesses, which supply goods and services to the electricity distribution market, are worth careful scrutiny. And finally, with all this discussion on power sector and the fact that beyond the medium term, in the next 5 to 8 years, India is actually going to see a rising trajectory of increasing power rates. All generating companies, whether in thermal or in renewables, are actually going to see a long period of very attractive profitability. So power generation companies certainly would be my priority for today's discussion.
Generation, battery storage or energy storage, it could be pump, it could be something else, and largely companies which has got to do with the road. These are the three themes, right?
Right.
Well,
you got it.
Thank you very much. I mean, you've been very, very explicit, and you've been very you made it very simple for our viewers. Even though who says infrastructure complicated?
It's not. It's actually very simple.
Well, thank you very much.
Thanks.
Let's take a break.
Yeah, we'll do that. Before that, here's a quick programming note. ETNA and ETNA Swadesh, in line with helping Indians rise with India, have partnered with Sundaram Mutual Fund to launch Nivesh Day, which is a groundbreaking campaign to help viewers build their personal finance portfolios through regular and disciplined investing. And it's Nivesh Day, which will be celebrated on the 5th of every month. So join ETNA and ETNA Swadesh and Sundaram Mutual to learn how you can build your financial future with an SIP in mutual funds.